It's said to be unprecedented. But what does a top-heavy market mean for your financial independence? Hello, and welcome to the fastest 4 minutes in finance. Scott is away on spring break. I'm John Shrewsbury. According to a report by Reuters, the U.S. stock market is more top-heavy than it has been in over 100 years. Now, what that means is the 10 largest stocks in the S&P 500 now account for about 33% of the market value of the index. Following one of the strongest rallies in decades for the market, does that mean that a large correction is somewhere in our future? History would suggest maybe not. If you look back at the times when there was extreme concentration in the market, more often than not, the market followed up with double-digit returns. Now, of course, past performance is no guarantee for future results, and we can't even think that it might turn out the same way. But when you look at the numbers, there were 7 periods of extreme concentration in the market, the latest being back in 2020. Following those extreme periods of concentration, the market was higher by 23% in the ensuing 12 months. Deutsche Bank analyst Jim Reed says you probably only need to worry if you think technology is in a bubble or if a recession has merely been postponed. Reed says an aggressive, relentless rally is not, in and of itself, enough to justify a big correction. So, is technology in a bubble? Most of those 10 stocks are technology companies, and Ben Snyder at Goldman Sachs says that the median valuation of today's top 10 stocks are substantially lower than compared to the median in 2000, the last time that the tech bubble burst. He also says that those 10 stocks are 3 times more profitable than during 2000 or back in 1973, another year when the tech market collapsed. Now, in decades past, technology has been a lesser player in the overall economy. Today, technology can be thought of as being a dominant sector of the economy, much like oil and energy were back in the late 1900s. Technology isn't going away, and its influence and involvement in business will continue to be a foundational piece of the world economic picture. Analysts also say the average S&P 500 stock is relatively cheap. Now, all that being said, we would remind you that markets are volatile, and that is why you want to have your plan to reflect a long-term time horizon for your equity investments. Looking back to the dot-com crash of 2000, it took 7.5 years for the full drawdown and recovery of the market to take place. At the other end of the spectrum, it took the market about 5 months to recover from the 35% downturn driven by the pandemic in 2020. Now, if you're an investor, your tolerance for a tumble in the market should not only depend on your risk tolerance, but also your investment horizon. Remember, economic, political, and financial crises come and go. But in the long run, stocks tend to rise. Knowing that fact should guide and direct your planning to be sure that there's enough time between now and when you will need to spend your money to let that bounce back potentially play out. Most investors need buckets of money that you might need at a moment's notice, like in an emergency fund. Money you might need in a few years, that money should be conservatively invested. And the third bucket is money that you won't touch for 15 years or more. This is your money that you want to invest in stocks for growth and to keep pace with inflation. Top-heavy or not, a well-balanced investment strategy can keep you on track no matter what may be happening in the economy or the markets. That's the fastest 4 minutes in finance. Thanks for watching.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.